Hi, everybody. Welcome to the Patty Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Everybody, I am so excited about today's show. Joining me from London, England is Johanna Kyrklund from Schroders. She's the Chief Investment Officer, and I have to tell all of you, I was introduced to Schroders by our friends from Hartford. We were invited, the investment team was invited up to New York for a Schroders symposium, which, between all of us is kind of a big deal. And boy, was I impressed. So impressed that I kind of took a shot in the elevator and asked Johanna, would you be interested in doing a podcast with me about your views on the economy and this new paradigm shift that you express concern and opportunities called 3D Reset? And she said, sure, Patty, with her London accent. So, Johanna Kyrklund, thank you so much for joining us.
Thank you so much for having me on your podcast. I'm very excited to be part of it.
I will tell you, I was so impressed. Within 5 minutes, I just knew that you were different. So I wonder if you could give me a little bit about your background. Tell us a little bit more about Schroders. It's not exactly a household name here in the United States, but incredibly well-respected overseas. So why don't we open up that way?
Sure. Thank you, Patty. So basically, just my background briefly, I guess I'm what's called a European mongrel in the sense that I grew up in Italy, in Rome, and I'm half Finnish, half British. So very much a European mix. And I moved to the UK for university. I went to Oxford and then started working in the asset management industry. So I've been focused on asset allocation, trying to work out where to allocate capital globally since 1997. And I've been at Schroders since 2007, initially leading the multi-asset team, which basically is a team that invests across assets, and then becoming the Chief Investment Officer in 2019. And Schroders is actually a company with a lot of history, has over 200 years of history. It's been in the United States. You might not know this. Well, you'll know it, Patty, because you attended our symposium, but we've actually been in New York for 100 years. It was our centenary last year. And we manage just over $900 billion on behalf of all kinds of investors, institutions, and individuals. And basically, I guess what we're really strong at is international active management. We're very strong in the overseas market, so we have a lot of US clients, but maybe we're not a household name because, we don't operate in the US equity market. We're much more focused on delivering the world to the United States. So I'll pause there to see what other questions you might have. I hope that sort of summarizes things neatly.
It is such a great introduction because, to your point, Schroders has actually been in the United States for over 100 years. And I find the history of your company fascinating. It started almost like a family office and has grown into a very large, if I may say, empire. $900 billion of assets is a lot. And what is so impressive to me, and was impressive at the symposium, is that there's no bias, right? You're open to almost any asset class. You just want to find the best opportunities for your investors across the globe. The intellectual capital also was so impressive. The team, oh my goodness, one person after the other just was as good as the next person, even better, especially with you leading that team.
Thank you so much. Thank you.
You got it. So I wonder if let's break this up into two segments, because the thing that was really interesting to me in the symposium was this idea of this 3D reset. Can you explain to us what that really is and what your outlook is?
Well, it really started, the sort of thought in my head started actually in 2020 when I had COVID and I got stuck I couldn't interact with my family. I was kind of feeling myself off from the family. So I ended up watching Downton Abbey from start to finish. So I was stuck on my own. And obviously Downton Abbey is set around the time of the First World War. And if you think about the First World War, that impacted a whole generation, and things were never the same after that. And that got me thinking about the pandemic, is that I don't think you can have a shock like that to the world and then assume we're all going to go back to exactly the way we were before. And that got me thinking more about markets. I think that, already heading into the pandemic, there were a number of big structural shifts. We were seeing a shift towards a peaking of the working age population. In the last decade, we had very cheap labor because of globalization and automation and many other forces. But, that kind of positive dynamic is kind of going into reverse for a number of reasons, partly demographic, but also accelerated by the pandemic, which really shifted working patterns. And we often talk about how, you're not going to get an inflationary environment like the 70s because you don't have organized labor. But if the whole global labor market's affected by the same shock at the same time, which is what happened with the pandemic, it's almost as if they were organized. Another key trend was deglobalization. We've been in an environment in the last 20, 30 years, which is all about opening up new markets and new sources of labor. And to some extent, due to a more tense geopolitical environment, we're seeing a reversing of that. Obviously, we still have globalized supply chains, but, at the margin, people are thinking a bit more about reshoring or nearshoring. And again, that was accelerated by the pandemic because we also saw the vulnerability of global supply chains. And then finally, decarbonization, which, ultimately is a major trend, particularly in Europe, but also in other parts of the world. And the point is that all of these things together mean that at the margin, there is a deterioration in the trade-off between growth and inflation, which means that so for a given level of growth, you'll have a higher level of inflation. And that means you're going to have a more proactive fiscal monetary policy. So the zero rate environment is over. And that really leads us into all kinds of implications for how we allocate assets, how we think about investments. But the point is we do believe that in the last 2 or 3 years, we'd be moving into a new investment regime.
So that's really interesting. So 3D, if I hear you right, stands for demographics, decarbonization, and deglobalization, right?
Yes.
So the demographic part of this is that, with the change in demographics, there are more older people and less younger people in the workforce. That's going to have an impact on inflation and the ability of those younger people to deliver goods and services to the older group. Do I have that right?
Yes, and you're seeing it already in the data. So, there's an economic relationship known as the Phillips curve, which looks at the link between the unemployment rate and wage growth. And that relationship was very flat in the last decade. So wage growth was very weak, pretty much no matter how low unemployment was. While we saw a sort of steepening of that curve over the last 2 or 3 years, as in for a given level of unemployment, we're getting a higher wage level. So you're already seeing more persistent wage growth than what we've become used to in the last decade. And that's partly due to demographic shifts. Yeah.
And that's probably here to stay. People are actually getting cost of living raises here in the U.S. and on a worldwide basis. Is that right?
Yes. Yes, absolutely. Because again, we're still in a situation where there's, some shortage of labor. I mean, I could talk forever about this topic, but actually in the last decade, what we found was that baby boomers were staying in the workforce for longer, possibly because of the financial crisis. And it was actually their presence in the labor market in the States that was depressing wage growth. We're now seeing that cohort retire, accelerated by the pandemic. And so now you're seeing the reassertion of more normal wage growth, more similar to what we had, say, in the 1990s.
That's really interesting, and that is so true. I see it with boots on the ground right here in Westchester, Pennsylvania. So I can really appreciate your perspective, especially over there in London, and recognizing that it's not just overseas, it's also happening right here in the United States. So when you think about decarbonization, what is the impact of that on the worldwide economy and leadership, especially?
Well, so decarbonization, what is that? Ultimately, we're kind of diversifying our energy sources. And that is quite fundamental. You're changing essentially the lifeblood of the global economy, or certainly diversifying that lifeblood. And that distorts investment patterns quite heavily. You're seeing a lot of bottlenecks in terms of, for example, metals needed for electric vehicles, for example. But then at the same time, a chronic underinvestment in traditional fossil fuels, which is also constraining supply on that front. So again, what we end up with, compared to the last decade where typically energy prices were pretty low, is an environment where we're more vulnerable to supply shocks, more vulnerable to higher prices. And then, of course, there's a geopolitical angle as well, which has kind of exacerbated that. But that is really, decarbonization is a somewhat stagflationary trend.
Fascinating. And how about deglobalization? I think this idea of reshoring or, having the supply chain closer to our borders, I was so fascinated to learn at the symposium that Mexico is now our biggest trading partner over China. So that's a really interesting trend that probably is going to be here to stay, right?
Absolutely. I mean, we're seeing this on a number of fronts, and I think even Schroders, for example, of course, the UK has become a low-cost, I'm joking, it's not that bad, but since Brexit, we're in a slightly more difficult position, but we've even been bringing jobs back to the UK, right? Mm. Now, there's a number of things going on here. One is a more geopolitically tense environment. We're moving to a multipolar world, which is changing the dynamics. And generally, people are feeling the need to, at the margin, protect their supply chains and make sure they're not too reliant on a highly globalized supply chain. I think on top of that, the pandemic exposed the vulnerability of global supply chains. And then, of course, there's a political reason as well. Essentially, the system we had in place over the last decade, which was one of, a globalized labor force, manufacturing being outsourced to overseas economies, ultimately the average person wasn't doing well enough out of the system in the West. And that led to a shift in political policies. So, for example, we had the Brexit vote in the UK. We've seen, for example, the slogan, Make America Great Again in the United States. All of this is a response to the fact that actually, as I said, the average person wasn't doing well enough. And so there have also been, political impetus to bring jobs back. And all of this ultimately leads to, at the margin, we're still dealing in a highly globalized economy, but what I would call the sort of Adam Smith on steroids, the invisible hand of Adam Smith on steroids, driven by extreme globalization, I think it is slowing down. And again, that was a very deflationary force in the last decade and is going to be less so now.
So with that in mind, if inflation is here to stay, if you translate that into where you deploy resources, what do you think about the implications for the bond market, for example? Is that still going to be a good place to have capital?
Yes. So I think the key thing is, so first of all, we're not saying inflation is always going to be high, but we're going to be settling, we're out of the deflationary environment of the last decade. We're going to have a more normal inflation cycle and the return of a rate cycle, which we didn't have for a very long time. And that means we need to recalibrate the ranges we expect for bonds. So in the last decade, we got used to, in many cases, even negative yields from bonds. I mean, it seems crazy to remember that now, but that's where we were, certainly in Europe. And in that environment, we were still owning bonds because of their negative correlation with equities. We owned them at any yield. In an environment where you have the return of a rate cycle and potentially more inflation in the system, i.e. no longer a deflationary environment, bonds are not as diversifying. We would expect the correlation between bonds and equities to be closer to neutral at best, if not slightly positive. But you own them for their yield. So the good news is that yield has been restored in fixed income. We're owning it for the old-fashioned reason, to generate income in your portfolio. The point is that we have to recalibrate the ranges. You need to be compensated via yield for owning fixed income. So I think there's absolutely a role for fixed income, but you need to get a yield now. And you don't own it for its correlation benefits. You own it based on the yield it can deliver for you. So this year, I think, is a good year for bonds because they have good starting yields. And if the Fed starts to cut rates, you could see also some capital appreciation. But the point is we have to have different ranges for when we own bonds and potentially be more ready to take profits when the opportunity comes.
So I'm curious, you've mentioned here in London, overseas, Europe, et cetera. If we go back to the 3D reset and your outlook, is every economy affected the same way?
No, it's really interesting because essentially we're seeing, the emergence of new forms of policy. If you think about it, over the last 20, 30 years, almost starting with Reagan and Art Laffer, we sort of got used to an environment which was all about keeping government spending under control, so tight fiscal policy and loose monetary policy. And that was kind of the orthodoxy over the last couple of decades, which reached its extreme after the financial crisis with zero rates. That system, as I said, wasn't working for the average person. We're now moving to a new world. And as everyone is trying to work out what the right policy mix is, as that whole framework's being challenged, different economies are going down different paths, partly based on the cards that they have been dealt. So take the United States. The United States has a significant advantage as reserve, its reserve currency status, a safe haven. That means that the US has actually been able to run looser fiscal policies than other major economies, because actually you still have demand for your bonds, and you've ended up with much stronger growth as a consequence. In Europe, we're really on the path of fiscal consolidation, partly because certainly continental Europe is very concerned about too much government spending. They're quite old school in that sense. They were scarred by inflation during the Weimar Republic of the 1930s in Germany. So they're still very focused on the old policy mix of keeping fiscal policy under control. Japan, actually, having been mired in deflation for a really long time, has actually been running a very loose monetary policy because actually they want some inflation in the system. So basically we're seeing huge policy divergence around the world as everyone responds to this new regime in different ways, partly based on their philosophy, but also their, as I said, the cards they've been dealt and their ability to do things.
It was so interesting at the symposium. Boy, did you nail it. You basically told all of us in the audience that United States is probably going to do just fine on the equity side. And you also mentioned Japan also doing quite well. And sure enough, we ended the year and both economies, both markets surprised, I think, everybody. So good for you for that outlook. As I think about things,
thank you.
Yeah, you nailed it. You nailed it. Very impressive. So here's a question. When you think about this paradigm shift, I'm just curious. You mentioned Germany in the 30s, et cetera. How often do these shifts tend to occur? Well,
I've been focused on asset allocation since 1997. So we're getting on to, this year will be, I'm now losing track, but is it 26 years, something like that? And, I haven't seen this kind of shift in that time. So I guess as I started in the late 90s, we're just moving into that more deflationary dynamic. We moved into the tech bubble. Asia was already having its crises in the late 90s. So I think, this concept, if you think about it, in the 90s, we'd already had a situation where people were really focusing on getting their government finances under control. We saw this with the German reunification. We saw this in Canada under Paul Martin. So around the world, everybody was getting their fiscal books in order over the 90s. And ultimately, there was a whole debate. If you remember in the late 90s, people were saying, is it fire versus ice? Will inflation come under control? And it did. So that's really, for most of my investing career, I've been in that environment of falling inflation, fiscal policy being run tight, ultimately monetary policy being run loose. So it's the first time I've seen a major shift. These are quite big structural shifts. I've never spoken about a different regime in the years I've been managing money.
So I think that's a great way to end our first episode together, Johanna. I think it will be really interesting in the second episode to see what this shift means in terms of your outlook for the future. Where do you see the opportunities? Are there any landmines? I think your perspective and your insights are fascinating. My next question is going to be, now, how do you apply all of that? So, Johanna Kyrklund, thank you so much for joining us today from Schroders, from London, and thanks to all of you for joining us as well. This is Patty Brennan, Key Financial Wealth Management with wisdom and care. Have a great day.